Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Today on the podcast, we have Mike Hananel joining us. Mike is the CEO of Strategic Growth Real Estate, Inc., the commercial real estate brokerage, investment, and property management firm he founded in Los Angeles in 2012. Michael brings nearly 30 years of entrepreneurial experience in business operations and real estate management to the table. Thanks for joining us, Mike. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, for sure. Thanks, Gary. So, born and raised here in Los Angeles, and so our focus is multifamily real estate. We do brokerage, property management, investments. I'm an investor as well, which is what got me into this field. Was I was interested in investing. Probably my first investment was in 1998, but I really started focusing on investments more in real estate in 2002. Eventually got my broker's license and started practicing real estate here in Los Angeles. So, and over the years, I've invested in other markets. I focused on Buffalo, New York for about 10 years and built up a portfolio of properties there. I did a number of syndications, brought in investors, and then sold that portfolio in 2015. But from 2012 till now, I've been focused on growing my LA business, which is the company you mentioned, Strategic Growth Real Estate here.
So I know you're a big student of the economy, money, monetary policy, and when I was reading your bio, I read that you picked Buffalo because you were doing a lot of data analysis, and Buffalo ended up turning into one of the top places to invest. What was the data that you saw that blew you away?
That's a great question. So yeah, when I first started looking at Buffalo, it was the 73rd best real estate market out of the 100 largest cities in America. So not very notable. And a lot of my investors who were LA investors who ended up investing in the Buffalo portfolio, their initial questions were like, why Buffalo? Why are we investing in Buffalo? And at that time, this was 2005. The LA market was going like gangbusters. And what I had seen was that the Fed was aggressively raising interest rates from 2004 to 2006. And I was pretty convinced that they were raising rates at such a rapid pace, not unlike what's been happening in the last couple of years now, that I was convinced that the LA market was going to take a dive. And they had, lowered interest rates before that because of the NASDAQ crash of 2000. So I think they had lowered rates for too long. It created this bubble mentality, and now they were raising rates too aggressively into this bubble market. So I started selling my own real estate and was looking at other places because a lot of my investors and clients would say, well, we'd love to invest, in other areas, and we'd love to sell while our LA real estate is sitting at all-time high values at that point. But nobody wants to pay the capital gains taxes. So they're like, is there anywhere else that we can exchange into? And so I started thinking, well, maybe there's another market. So I started looking around the country and I created a list of criteria of what I felt was important. One of them, certainly, I wanted something that was either a secondary or tertiary market, something that wouldn't have been as driven by the market cycles as Los Angeles or a lot of the big cities. Certainly, places like Miami and Las Vegas, and even Phoenix, they get very overdeveloped during good times, and then when things crash, they overdevelop, and then markets soften, and so you go through a pretty big boom bust cycle. I mean, even in LA, we have it, maybe not as dramatic as some other markets, but I wanted a secondary or tertiary market that would be more stable. Also, I wanted to see a market that had some, pretty diverse economy, which, believe it or not, Buffalo actually fit that bill in terms of, the economy was based on banking, biotechnology, education. Tons of universities in New York, are based in Buffalo. And I saw a lot of the locals that were buying abandoned old office buildings that had been vacant for decades and putting all this money into them and building luxury apartments. And they had pre-leased them all before they even finished construction. So for me, I was like, well, that's very interesting that there's like this pent-up demand for people wanting to move back into the urban core. Buffalo is another one of these Rust Belt cities that got killed in the late 70s, early 80s, where there was just urban flight. Everybody left the downtown core, went into the suburbs. But as you know, in the last couple of decades, there was a reversal of that, and people moved more into the cities. Of course, COVID is now reversing that yet again. But at that time, people were moving into downtown core. So that's what got me into it. And I went out there, and the cap rates were like 9 and 10. And the cap rates in LA at that time was like 4 and 5. And I was like, wow, that's like double the return, and you get greater leverage. I was able to find local lenders that can give you 80% loan to value. So all these reasons were like, wow, I think the Buffalo market would fare better because it had been a depressed market for so many years, and it had been slowly working its way out of that market for so many years. And it proved to be a great thesis. By the time I ended up selling, which was in 2015, there was another report that I saw that of the 100 largest cities in America during the Great Recession, believe it or not, Buffalo was the number one market in the United States because it was one of only 3 markets where real estate prices did not fall during the Great Recession from 2008 to 2010, let's say. But prices in Buffalo just kept going up. So it worked out great. I mean, I timed it luckily well, which is very hard to do, as you know, in real estate. And so then we ended up selling in 2014, and my investors made a 342% return, and I made a lot of money, and everybody was happy. And now I've been just really focused on LA. So from 2011 to 2019, I was very aggressively buying properties in LA because we did have a downturn. Mostly the downturn was in residential. And so the deals that were, more readily available, I mean, I picked up foreclosures and at the courthouse steps on like a lot of fourplexes. So it was like residential, 4 units and below. The commercial properties, really, there wasn't a lot of defaults. There weren't that many deals. We did see cap rates go up, certainly a bit after the Fed had raised rates from 2004 to 2006, and then we had the big crash. Cap rates were certainly higher than they were before that. But then again, the Fed lowered rates and cap rates kept coming down. And so I was buying along the way down as the cap rates were coming down. By 2019, the cap rates had gotten so compressed. I mean, most of the deals are like 3s and 4 cap rates. Now already we're seeing 5s again in LA, which we haven't seen in a few years. So I think the market's shifting again, and hopefully I'll be able to be buying some more again very soon. That's the plan anyway.
It takes so much, like, I don't want to say willpower, but like to stay with your thesis and to go from LA to buy in Buffalo and then to like stop in 2019. I mean, that's really, really like, that's a seasoned investor to stay to your thesis and whatnot. So that's really impressive. Where do you think the market is going in the next few years?
Well, I'll tell you, it's and thanks for saying that. I mean, it's a similar investment thesis, I would say, to Warren Buffett, where he is sitting right now on records amounts of cash, which for most people it's very hard to sit on certainly that many billions of dollars and not want to, make that money work for you rather than sitting in treasury bonds. But I still believe that all you have to do is be patient and make few but very large investments at the right time, and you can create great wealth. And I did learn sort of that thesis from reading a lot of stuff about Warren Buffett earlier on. The market in LA is definitely softening. I mean, we're seeing transaction volume has dropped a lot in the last couple of years. It started to pick up again this year, and then it stalled again because now interest rates went down and then they went back up, and now they're starting to pull back again. So it's a weird, volatile market. Nobody knows, is the Fed going to lower rates, or actually maybe they'll even raise rates? People don't expect that, but if we see inflation coming back, they might actually even raise rates further, which would be, certainly detrimental to the real estate market. So yes, cap rates are now, like I said, hovering in the five, in the high low fives, which they haven't been in a long time. If they were, let's say, in the low fours, and now they're in the fives, it's already a 20% decline in price. I think there's a lot more to go in terms of where the pricing needs to be. My metrics have always been 200 basis points, which is a spread above the cap rate or above the interest rates that you can borrow that I need to see in a cap rate. So like my last deal that I mentioned in 2019 was a small 6-unit building in downtown LA. It had a 6.5 cap rate on it. I was able to borrow at 4.25% interest at that point, in 2019. I still have that loan. I still have that property in it, and it's cash flowed. So I need that 200 basis points. It's very hard to find because right now, let's say an interest rate on a loan is 6.5%. So that means I need a 8.5 cap rate, which you just can't really find that right now in LA. So I'm still being patient, but as the cap rates go higher, I think we're going to see more and more deals. Especially what's happening is a lot of these commercial loans are starting to be reset, meaning they have to refinance because their 3-year or their 5-year fixed period is ending. So this year, there's a lot of commercial debt that's having to be refinanced at much higher rates. And if they haven't increased their net operating income enough to justify these higher payments, they're going to be forced to either come up with cash to refi that or walk away from the deal. And so there could be some foreclosures in the next couple of years as rates stay high and who knows, may even go higher. So I think there's still going to be more room for this market to run. I'm, like you said, I'm patient, so I'll keep waiting. In the meantime, we've been focused on growing our third-party property management with all the stuff that's gone on with COVID and all the laws changing. I mean, it seemed like every month there was a new law in LA for COVID. We had to constantly adapt and change to changing market conditions. And so we got really good at management, and it's attracted a lot of new business for us. So luckily, my business has continued to grow, but it's just in the third-party property management side.
So because you're a big student of money and monetary policy, obviously the Fed also has a ton of debt they need to refinance. You've got all these conflicting data reports. A bad job report is good, and a
Right.
good job report is bad.
Yes.
Do you really think? I know they've kind of hinted like, oh, we could potentially raise rates, and I think it's really just to calm the euphoria in the stock market and Bitcoin. But where do you think rates? No one has a crystal ball, but in a couple of years, you think we get back down to maybe it's instead of 6.25 right now on agency debt, is it 5? Is it 6.25? Is it 4.25? Where do you think we're headed in the next few years?
So what I think is going to happen is there's going to be some cause for alarm in the markets, whether it's another, last year we had banks collapsing. The market seemed to shrug that off pretty easily. It could have led to a lot of stuff. The FDIC came in, they closed up those banks. Of course, JP Morgan always ends up with whatever banks goes under. It seems like they want things to crash. So I think we're going to see some more crises like that, whether it's more banks, certainly any let's say, regional commercial banks that's focused in office. Those guys are hurting right now. And as office buildings come up for renewals, we're going to see more and more office buildings trading at, either crazy high cap rates or, below replacement costs. And those types of things really tend to set new values. Of course, multifamilies is a different animal, but it definitely has an impact. When the banks are hurting, they're going to start, continuing to tighten their underwriting. So until but I do think that there's going to be a crisis, and it's going to force the Fed to lower rates. So if I had to guess or predict, I think yes, we're going to see rates lower a year from now, because within that year we're going to see a crisis, one way or another. There's a lot of geopolitical things going on. As you know, gold has been hitting new all-time highs. That's usually a sign that the dollar might be in trouble, even though the Fed's been raising rates and rates are higher. Typically, that means the dollar is stronger, which means gold is usually lower. So the fact that gold is hitting new all-time highs while the dollar is also very strong tells me that we're one crisis away from the dollar collapsing, gold going up, and then the Fed, because they have to fix everything that they've caused, I think they caused the breakage of the system, they're going to lower rates quickly. So a year from now, it's highly likely rates will be a lot lower. That doesn't necessarily mean that cap rates will fall, because like I said, if we're seeing banks fail and we're seeing crises, we could still see cap rates going up even as the Fed is lowering interest rates. So I
I
think
think
that's
everyone is banking on, that they're in correlation. It's not necessarily, it's, in step completely.
and it's
Certainly it has an
usually
effect. But
it has an effect, and it's usually very much delayed. Like my experience has been cap rates take like 2 years to catch up to interest rates. I mean, like I said, in LA, only now are cap rates at 5, but we've had commercial rates at like 6.5% now for over a year. So it hasn't really caught up yet. So it's a slow process. As real estate, also transactions move slowly. It's not liquid like stocks and bonds are. So it takes a while for things to work its way through the system. Also, people still have that cheap debt. They still have low interest rate debt that they haven't been forced to refi yet. None of my loans come due till 2026. So I'm hoping there is a big drop in rates by 2026 when I need to start refining all my properties. So, yeah.
let's talk about, you're focused on your property management company now, and I think a lot of investors struggle with finding a really good property management company, and so some people leap to start their own property management company, which is something I don't want to do, because it is a thankless job. But like, you know, how does an investor find the right one for their business? What makes a really good property management company?
Yeah, so I mean that is exactly why I started my own property management company, was because it's very hard to find a good third-party property management company. The people who do a great job managing properties typically are larger institutional investment companies who do build their own management teams. And so ultimately it is very difficult as an investor to find a good third-party management company. I mean, I believe we are an excellent third party property management company because I look at everything from an investor point of view. And so I'm constantly trying to push the envelope and to increase the NOI for my buildings, but for all my clients' buildings. And my team always knows that my clients' properties are always prioritized over my own properties. Like if there's multiple vacancies, let's get the other ones done first before you worry about mine. I think systems and software systems and people are the key elements. I've got an amazing team, but it took me many years to build a team that we've got now. We also switched our software to AppFolio at the beginning of 2023. I was on Yardi for many, many years. I mean, when I started in this business, Yardi was pretty much the only game in town. But with the internet and with all of this new technology, Yardi, in my view, didn't really keep up. And so there was a lot of stuff that you could do with AppFolio and other software providers that we wanted to be able to implement. So we made the difficult choice last year to change our system. And it creates a lot of other added value points. So for example, RUBS, it stands for ratio utility billing service, RUBS. A lot of people are implementing RUBS. It used to be you had to find a third-party company to hire them and do RUBS to basically, create a ratio for utilities that the landlords pay and charge those back to the tenants. And because of LA with our stringent rent control, we can't raise the rent. For 4 years because of COVID, we couldn't raise it at all. This year, they let us raise it 4%. But once a year, you raise it whatever the city allows you to. And our expenses are increasing at a much faster percentage than we're allowed to increase the rents. So it's forced us to be a lot more innovative and industrious in terms of how we can get our costs passed through to the tenants, because we can't do it in the rent because of the laws, right? So we're having to pass through expenses through utilities. So now with all new leases, no utilities are included. So even utilities paid by the landlord, whether it's trash removal, water, sewer, electricity, we pass through a ratio to each of the tenants. So that's one of the things that we do. We also are very good at just staying in tune with what's going on in our units. So doing walkthroughs twice a year at minimum, but finding out, for example, just when a maintenance guy may go into an apartment, finding out if there's more people living there than what's on the lease, if they've moved pets in, and then if so, charging extra for that, because again, there's only certain things that we can do because of rent control laws to increase the revenues and help reduce our expenses. So we're constantly doing that. And as it relates to vacancies, we're very, very fast at moving when there's a vacancy. I like to have a unit turned over and on the market within a week of being vacant. Unless, of course, it's a major renovation. If it's a normal paint and clean, 7 days is all I give my team. We got to get it back on the market, try to get it rented by middle of the month. So maybe there's only 2 or 3 weeks that a unit is sitting vacant. Certainly no more than 30 days. If a unit is vacant more than 30 days, there's either a problem or it's just a major renovation that may take a little bit longer. But even a total renovation, usually we can get it done in about 30 days. So moving quickly, being efficient, having a good team, being responsive, especially with things like water leaks, you got to get on that quick and get to the building quick, because those things turn into other problems and other expenses and other repairs if you don't get onto them quickly, besides the added water bill, et cetera. So, putting systems in place and having the right people is critical for management.
I think most people would kill to have that timeline, that speed of getting things done, because that's always everyone's complaint. It just takes so long with another company to get things rolling, and then time kills, all profits.
Yes. Think about an average 2-bedroom, $3,000 a month. That's $100 a day you're losing by not having it rented. So I remind my team of that, and so that really motivates them to move quickly, to plan in advance. When we get notice from a tenant, we get into that apartment before they move out, so we know what needs to be done. The minute they're out, we're already there that day or the next day, cleaning, painting, getting it rent ready. So that type of efficiency is really important to me, and I drive my team to those metrics.
Where do you think the property management world is headed in the next 5 to 10 years? How do you think it'll evolve? Because I know it's very typically it's not very tech forward. So I'm curious where you think it's headed.
Well, with companies like AppFolio that are continually pushing the envelope and adding new services, you're going to see a lot more AI stuff come into play. We're already using it with AppFolio. So, for example, one of the AI features that I think is really brilliant is in our accounts payable. So because I have a high expectations from my vendors of, I want things done, I want them done quickly. They also want to get paid quickly, and that's only right and only fair. So we have this AI piece where we create a separate email address specifically that AppFolio basically creates for you. And so you tell all your vendors, email your invoices to this email address. And then AppFolio has an AI software that reviews the invoice and can figure out what building it goes to, what apartment it goes to, what expense it is, like, oh, this is plumbing, this is electrical, This is for this building. This is for this apartment. And it will put all those GL codes into your accounting system and be ready to cut the check. And all you need is for a human to look at it and say, yep, AI, you did that right. That's the right building. That's the right account. If not, they can obviously make an adjustment to it. So just even something as simple as accounts payable now is so much more streamlined because of AI. And the same type of stuff we're seeing in customer service response. So Appfolio has some good tools for marketing, like for leasing apartments, but we have found other tools that are better, like Show Mojo is one that we use, for example, and it integrates very well with Appfolio. And what Show Mojo does is it takes the vacant unit that we have that we're about to put on the market for lease, and Show Mojo will do all the, I know Appfolio can do this as well, but Show Mojo will put it on all the different sites to advertise it, apartments.com, Zillow, wherever you want to put it. And then it will help you make appointments to show the apartment by you have your leasing agent say, I'm available for these hours on these days to show the apartment. And then as long as it's within those hours, the person who wants to see the apartment can see the schedule of available time and say, oh, I want to see it on Thursday at 3:00. And it will automatically make the appointment with the leasing agent. And then it will automatically reconfirm the appointment multiple times automatically. Like it'll send an email or text. It'll remind you, hey, don't forget you have an appointment tomorrow. And then in the morning of, it'll say, please reply that you're coming to this appointment. Because if you don't reply, the leasing agent won't show up. But if you do reply, they will show up. But it's things like that that are automated, which most salespeople, if you're showing a lot of apartments, it's very hard to stay on top of following up. And then you go and most people don't even show up to look at an apartment, so it's a big waste of everybody's time. So if you use AI tools like that, you're saving a lot of time for people and you're making it more efficient for the leasing agent to show more apartments. So that's how we also get our apartments leased very quickly, by using tools like that. And we are starting to see in LA that the rental market is slowing down. I read recently that rental rates have dropped 3%. From like a year ago, we're seeing the rents are about the same for our apartments, but it is taking a little bit longer to rent. And there's just less people showing up. So it tells you there's just, the market is starting to slow, but it's still very early. Rents haven't really fallen much, but the number of people looking has. So that tells you that things are starting to shift in the economy.
Yeah, and our slow compared to other markets is, like there's just such a lack of units here in LA that the vacancy is so small.
Yeah, we're still, some reports I've seen 4%, but our portfolio is we never have more than 2% vacant at one time ever. Like it's rare that it gets above 2%. But that's also because we're pretty efficient and we're turning things quickly. But yeah, we're lucky, but yet there is an exodus, there is an actual population decline in LA for the first time ever. And I've lived here my entire life. So that's a pretty big deal that it's starting, but it's such a big city. Like you said, so far, we're not really feeling it too bad yet.
Mike, I appreciate you coming on the show. You had a ton of value on quality versus quantity, picking the right times, being patient, what good property management looks like. And I'm definitely going to check out the Show Mojo. Where can listeners find out more about you and your company?
Yeah, you can go to our website. It's strategicgrowthre.com. And there's a forum right on the homepage if you want more information. Our phone number's on there. You can certainly reach out, send us an email, and be happy to talk to anybody.
Awesome. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.